Thank you, Secretary Letta, distinguished guests, visitors, pension managers, and all of you. It's a great pleasure to be here today. Can you hear me all right in the back? Yes, okay. I guess I don't know whether you can hear whether she can hear me or not. Okay. So I would like to talk with you today about the financial crisis that we have experienced, whether it's over, what we can expect in 2010. And I'd like to tell the story from the point of view of the volatility that we've seen in financial markets. The volatility is one of the most dramatic features that we all experienced, especially last fall. And it gives us a way of talking about risk in financial markets and how we actually manage this kind of risk and whether we manage it well or badly. And these are all at the heart of many of the questions that Professor Brambilla discussed this morning. We all know that every day asset prices change. The stock market goes up and the stock market goes down. We also know that it's very difficult to predict those changes. It turns out what we can actually predict is the magnitude of the changes. Some days these changes are large and some days the changes are small, and we can actually form predictions of the volatility of financial markets. And that's what I'm going to talk about, because it's the volatility of the financial markets that tells us how much risk we're taking. It tells us how much could we lose in this investment over the next trading day, for example. And when we talk about this kind of measure of risk, we have to ask, did it give us the right answers during this crisis period of last fall, or did it break the same way other models broke? And the model that we're going to talk about is basically the ARCH model. It has a relatively difficult name. It stands for autoregressive conditional heteroscedasticity. I don't know how that translates into Italian, but it has two common features. It describes the risk in financial markets based on two features of financial markets. And these features are called volatility clustering and mean reversion. And what they tell us is that when financial markets are volatile, they're likely to stay volatile. And when financial markets are calm, they're likely to stay calm. That gives rise to volatility clustering, that there are clusters of periods of high volatility. And the second feature is the mean reversion, which says that when volatility is high, it will eventually decline, and when volatility is low, it will eventually rise again. It turns out, with these two ideas in mind, we can form econometric models that can predict volatility. These models have names depending on exactly how you do it: the ARCH model, the GARCH model, the threshold GARCH model, and so forth. But we won't deal with those issues today. This model turned out to be sufficient to get me invited to Stockholm a few years ago, and there you see me in the front row seat between my long-term colleague, Professor Clive Granger, who sadly passed away in May this year, and the literature Nobel Prize winner John Coetzee on the other side. The Swedish Royal Academy is behind. The Stockholm Philharmonic is above, and it's a most glorious occasion. However, most of the audience was not watching me. They were watching the Swedish royal family, who was on the other side of the stage. And this is the crown princess. My son thought she looked like she would be a nice person to get to know, although she does have a boyfriend already. The king presents the Nobel Prize. My wife congratulated me in the shadow of Alfred Nobel in the background, and you can see the medal in the foreground. And it's an amazing week of festivities. But what is this model anyway? What can you do with an arch model? What I've shown here in red is the returns every day from the Standard & Poor's 500 stock index in the U.S. And then plotted in blue and green are the predicted standard deviations from the Garch model. And so if I look at 3 standard deviations above and 3 standard deviations below, I get a kind of a confidence band which predicts every day what range the stock market is going to fall in. And you can see that almost every day this 3 sigma range includes the outcomes. So we have some confidence band of what the stock market is likely to do. The most noticeable feature is that there are periods of low volatility, such as the middle 90s and 2003 to 2007, when the volatility was very low. There are other periods when the volatility was very high, around the internet bubble, around the Asian currency crisis, and on the right-hand side, you see the beginning of the financial crisis we have just experienced. The bottom curve is approximately what we call value at risk. It's a measure of the risk in the market every day. And you can see that when the bottom green curve is large in absolute value, that is, it's very low, the risk is very high. And when it's more moderate, the risk is a lot lower. So if I show you some pictures of the volatility, we can think about these as ways of measuring the risk in the market. Why does this model work so well? It's surprisingly efficient a way of estimating volatility for almost all financial markets that we've looked at. And this is in spite of the fact that it's a very simple model. Am I okay? It's a very simple model. It uses only historical data and these 2 features of financial markets to describe the volatility. Why does it work so well? Well, one answer that my students tend to believe is that this is the way the data is generated. What I think is a better answer is that financial data is the outcome of decisions by investors like yourselves as to whether the price is worth the future payments that you can expect. We do analysis of the value of stocks, of countries, of companies, and in doing this fundamental analysis, we ask, what are the expected payoffs? What can we expect the rewards from holding this particular asset to be? And we use every piece of financial information available to do that forecast. And so when there is new information, it changes the amount we're willing to pay for this company, and that's why asset prices change. So fundamentally, it's new information that produces volatility. When we say that financial markets have volatility clustering, what that means is that the news has volatility clustering, and high volatility means a cluster of important news. And I think if we look back at a year ago, when you read the newspaper every day and you watched the business news, you saw news which was more important and more influential on the financial markets than we've ever seen before. Every day we saw another story about a company that was going bankrupt, whether the government was going to step in, whether interest rates had gotten to zero, and what was going to happen with the central monetary policy. These were amazingly important pieces of information and led to the high volatility of the financial markets. And it's not that volatility, therefore, is a bad characteristic. It's that it reflects how much uncertainty there really is. And when we see high volatility, we have to think that there is high uncertainty about what the future holds. So let me show you a few pictures of what's happening to financial market volatility. These are pictures from a website that we do at the Stern School. It's called VLab, which stands for Volatility Laboratory. And we think of this as a laboratory where we are examining volatility over time. And these are publicly available, and what I'm going to show you is publicly available. In fact, one of the slides I pulled from my computer in the hotel room this morning, and if you're connected to the internet, you could look right now. So what do we see in VLab? Well, here, for example, is the last 2-year experience of the S&P 500. It's shown in red, and this is a volatility model. And on the right-hand side is a scale which we use to measure volatility, which is the annualized standard deviation. In fact, over history, that was about 15%. But over this 2-year period, you can see it only rarely has come as low as 15%. It's mostly much higher. And at the peak of the financial crisis, it was up to 80%. Enormous increase. But you can see that the volatility has been gradually but pretty steadily dropping, especially since last March. We think of last March as the turning point in most equity markets, but it was also a turning point in volatility. As the volatility has fallen, the markets have risen. But it's not been such a smooth fall. You can see there are several episodes where volatility has jumped back up again, and we have asked ourselves in each case, is this the beginning of another crisis, or is this just a short-term volatility spike? You can also see on here in pink the volatility index, the VIX, which is a measure of volatility which derived from options prices, which is a totally separate measure of volatility that is also widely used to forecast the volatility that we can expect. It's also basically the price of a variance swap that you can actually trade. And you can see that they move very much together, but that in the most recent period, there is a very large gap between them. That the options price estimate of volatility is especially high compared to what the Garch volatility is saying. There is typically a small gap between them, but this is a large gap. And there are two interpretations for this gap, which I would like to mention. The first is that the Garch model is a very simple model. It only uses the past information on the stock market price, whereas the options market is the optimal forecast of the future based on traders who read the newspaper and know a lot of things that are going on that are not in the Garch model. And so it may be that options traders are more pessimistic about this financial market recovery than the simple volatility estimator. The second explanation is that there is always a risk premium between these two, which reflects the fact that volatility is based on options prices, has a risk premium in it. It's an estimate of the volatility. When we say technically, it's the risk-neutral volatility as opposed to the empirical volatility. And consequently, when times are risky, there is a premium, and we're going to talk about that premium when we get a little further. But it may be that what we're seeing is a big risk premium by individuals who would like to buy options to hedge the future. So those two interpretations are there. Let me show you what I pulled this morning, because this is a volatility forecast that was made for yesterday. It's made in the U.S., so it's 6 hours behind or something like that. And you see in the bottom, the green curve is what the actual stock price has done. The blue curve is the change in the stock price. And you see the collapse in the market associated with the Dubai event on the day before yesterday. The next to last day, you see the green curve drop down and volatility's jumped up. Particularly, the VIX jumped up a lot, and the GARCH jumped up a small amount, and then recovered to some extent when the markets yesterday didn't show the big drop that was predicted. So we can follow these events as days go by to see what is happening to these financial market indices. So let me kind of quickly show you a few other pictures. This is what happens to various sectors in the U.S. economy. The red one is the financial sector, and as you will not be very surprised to see, the volatility of the financial sector in the U.S. reached very high levels. At the highest, it was over 140%. So remember that the market as a whole reached a peak of 80%. This is well exceeded by the financial sector. We also see on here the energy sector, which also was extremely volatile last fall, but has come down much faster than the financial sector. You see in green the industrials, in blue healthcare. In the U.S., you might imagine the healthcare sector would have high volatility as we're debating the healthcare legislation, but it doesn't seem to have had a big effect on the volatility of this index. If you look at the bond prices, you can see a rise in volatility during the crisis, but it's not very high. This is because bonds are much more stable in terms of the volatility of their returns. Even though bond prices do change, they don't change nearly as much as equity prices, which is, of course, why we diversify our portfolios, including fixed income products. We are going to come back to a point here where you see, as the volatility went up in the bond market, you can see the green curve rises, which means that bond prices went up as the volatility went up. That might seem surprising. Usually, asset prices fall when volatility goes up. But for U.S. Treasuries, this seemed to be the opposite behavior. And maybe this is not surprising. When the crisis hit last fall, there was a flight to quality that we all sort of recognized, which meant as the volatility of everything went up, people bought Treasury bonds, U.S. Treasury bonds, because they were less volatile and actually drove up the price. The other asset that was bought at the same time was dollars. When we had this financial crisis, the high volatility in exchange rates was associated with an appreciation of the dollar. Not a depreciation, an appreciation. And you can see that as the decline in the green curve when the volatility went high. Many of you probably did this with your funds. When the financial crisis hit, you asked, what is the most secure asset you could buy? Many of you, I believe, might have bought Treasury bonds or other U.S.-based assets in spite of the volatility, because these were viewed as less risky than other assets. And you see, as the volatility has come down in exchange rates, the dollar has fallen. So this risk-based appetite for the dollar has dissipated as the financial crisis has moved behind us. We hope, we think. Finally, what about Italy? So the red curve on here is the Italian stock market, and as you can see, its volatility jumped up last fall, just as the volatility of other markets around the world. I've included here the IFA, Emerging Markets Index, Germany and Spain. Italy looked very much like the other global financial markets through the financial crisis, although you can see it has had a slower recovery than most other assets. The red curve is the highest on the right-hand side of this curve, which is basically from March through this summer, but now it's now sort of even with Germany and just slightly higher than Spain, although higher than the global indices. So this is a way of monitoring what's happened. It doesn't explain the causes. It is a way of understanding what's happened and a way of looking at risk as we go forward. What are the causes of this financial crisis? Well, in a book that 30 faculty at Stern wrote last fall, and which was published in March, we discussed many, many aspects of this financial crisis. It's one of the first books and it's to come out, and it's had a lot of press review. We're supposed to try to come up with an update next week. I don't know whether we're going to manage that or not, which talks about the legislative proposals that are being discussed in the U.S. and elsewhere. But this book has about 20 chapters which cover everything from the mortgage market to derivatives trading and regulation of different kinds. But it seems to me that there are two simple themes that we should keep in mind from looking at the crisis. The first is that risk was underestimated by many, many market participants. They did not realize how much risk they were taking. And this is particularly true of traders, money managers, bank CEOs and boards, rating agencies, regulators, investors, and even risk managers themselves. So we will want to talk about how can we get better ideas of how much risk is being taken. But the second and very important feature is that many of these same participants had strong incentives to ignore the risks. They were paid well for ignoring risk. The incentives were not set up right for them to avoid risks when they should have avoided them. And most of the regulatory proposals we're discussing are designed to improve these incentives. So let's turn, first of all, to how we could improve risk measurement. Were we prepared? I think the answer is no, but let's be more precise about that. Did we predict this crisis? Would a good econometrician or a good risk manager, should they have been able to predict this crisis was going to happen? probably that's too strong a statement, because the only people that predicted this crisis have been predicting it for 20 years. So it's not so helpful to know exactly, unless you know sort of when it's going to happen. I think a better question is, would this crisis have been in the confidence set? In other words, if we had looked at the possible outcomes, would they have included this crisis? And therefore, would we have known, if we were a risk manager, that there was a possibility it could get this bad? And if it's not in the confidence set, then was there information that we missed? And should we have been thinking about this from a better way economically? So let's go back to VLAB, because we've been forecasting volatility every day for a long time now. How did VLAB do through the financial crisis? When we forecast these markets, did it break down? It turns out, when you look at the volatility forecasts one day ahead, there is almost no deterioration during the financial crisis. In other words, if you measure the risk as to what is the confidence interval for tomorrow, you do very well. There are no 3 sigma events during the financial crisis. That might seem astonishing to you, but in fact, when the volatility is this high, it takes an extraordinarily bad day for you to lie outside of the 3 sigma confidence set. In fact, as money managers, you probably realize that's not the right question. The question is, would you have been able to foresee this further in advance? One day ahead doesn't really give you much time to get out of the market. You need more time to get out. So we also looked at longer horizon forecasts. 1 month ahead forecasts deteriorated quite substantially during the financial crisis, and so that when you forecast a month ahead, we did not forecast that the volatility could be as high as it was, and in a sense that I won't make precise, these forecasts were, however, still within the 1% confidence band of what we could expect 1 month ahead. There is an important lesson in this, I think, which is that most of the risk modeling that we do, and this is governed by regulatory requirements, but also conventional practice, is based on things like value at risk and expected shortfall, which are measures of short-run risk. That is, what is the risk 1 day ahead or 10 days ahead? And in fact, the 10-day ahead horizon is only done by scaling up the 1 day ahead horizon, so it's really basically a 1-day risk. But many securities that we hold for much longer horizons than this, and particularly if you're managing pension money, you're thinking of investments which have horizons not just in days but in years. So there is a mismatch between the horizon of our risk measures and the horizon of our investments. And the key risk feature that we're missing, I think, is the risk that the risk will change. That's what we're missing when we use a short-term risk measure to measure the risk of long-term assets. We're missing the fact that the risk itself will change. And so I'd like to make some comments about how could we improve our risk management system to incorporate the risk that the risk will change. So let's tell the economic story first. During the 2003 to 2006, many investors took the low borrowing rates and low volatilities to be a time to increase leverage. In fact, leverage was not very risky if volatility is low. And it's not very costly if borrowing rates are low. And in fact, most investment bankers that I knew were looking for ways to take more risk. They wanted higher returns. They had to reach target levels of return, and they had to take on more risk in order to achieve these target levels of return. This included CDOs, mortgage-backed securities, which had very good credit ratings. They were viewed as very low-risk assets because of the tranche nature of these products. Meant that you were more or less immune from any defaults that are likely to happen, even though the assets underlying these CDOs might be really poor quality, like subprime loans. In fact, if you were still nervous, you could buy insurance on these tranches from giants such as AIG. And all of these products had low risk, and you had multiple potentially insurance contracts against them. But all of these were low risk as long as the volatility stayed low. If you think about it, if the volatility were to rise, well, what would happen? Well, what happened when volatilities rose and correlations rose, because they typically go up together, all these low-risk positions became high-risk positions. And it became impossible to sell these positions because without taking a deep discount. The insurance that you had bought became worthless because everybody needed to collect it at the same time, and AIG and the other mortgage-backed insurers had insufficient capital. And yet, this was not actually very surprising that volatility should go up, because, first of all, we think mean reversion is a pretty common characteristic of volatility, so when it's low, it's likely to rise. And second of all, if you looked at the options market, you could see that long horizon options were predicting a much higher volatility than short horizon options. So I think the problem is that the typical risk measurement tools that we have did not warn us. They had no way of incorporating this mean reversion and volatility into our risk assessments. There was no way to incorporate the risk that the risk will change. And this is true for rating agencies, and it was true for investors. So some of the stories talked about in my new book called Anticipating Correlations. It's focused particularly on correlation changes and how that affected the prices of CDOs that are traded in the marketplace. But let's see if there's anything we can do to expand our notion of risk into longer horizons. The main way we use the main way we have now to look at long horizon is scenarios and stress testing, which is a very important part of risk analysis for our portfolios, I'm sure. What I would like to do is consider the idea that we could expand the standard notion of value at risk to include value at risk over longer horizons. And we can even use economic information to improve this estimate of what long horizon value at risk might look like. And so the idea is that we could start at any point in time and generate future scenarios as what could happen. But these future scenarios normally are created assuming that the risk is actually constant, the volatility is constant. We could instead create future scenarios which allowed the volatility to change. And so on some of these paths, the volatility would go up, and some of the paths, the volatility would go down. But the whole range of outcomes would be expanded by allowing the risk to change. So I'm going to show you some pictures. If you do this starting in July of 2007, which is more or less just before the financial crisis was first, well, we thought it hit in August, but we didn't know that a year later it was going to be a whole lot more serious. And I'm going to use the same model that we use for VLAB for forecasting volatility, which allows the volatility to change in this sort of standard mean reverting way. And if you do that, you can calculate value at risk at different horizons, and I've plotted it on the same graph with the future values of the S&P 500, and you see that little gap at the beginning is the value at risk that you would calculate for a one-day ahead movement. But then I've plotted against time the value at risk, the 1% quantile of all these scenarios, and I've got two curves on there, one of which assumes the shocks are normally distributed, and the other which assumes that they're fat-tailed like they were during history. And you can see that the 1% point is actually, and it's like the lower bound of these confidence sets that we looked at, but it's a long horizon lower bound of the confidence set. So we would be probably quite sure that this curve would lie above each of those bands. At each horizon, there's this probability statement we would make about what's the probability of being inside that band. But you see, it was really a year and a half later that the market got so bad that it crossed the band that we made in July of 07. Here's some more pictures where we start in January or September or June of 09. And you can see that if you start this in September of 09, that's the green curve, you would cross it almost immediately, September of 08. And if you started in June of 09, we get a very pessimistic band, the purple one, which so far we're not close to, fortunately. So we could do this every day and get an estimate of the whole term structure of the value at risk, incorporating the risk that the risk will change. If we instead did it without incorporating the risk that the risk will change, assuming that the shocks were independent and identically distributed, which is a common way to do scenarios, you would get the purple and the yellow curve, and you can see that they're much more conservative. They don't include nearly such extreme events as the two that we started with. And finally, if you say, well, there is information that volatility is likely to rise. This might be macroeconomic information. It might be a view that comes from the options market. It might be your chief economist says there are all these global imbalances. There are subprime loans that have qualities that are worse than people think. There are many reasons to think that the market is riskier than we expected. He might come up with the purple line, which has an economic statement in there which says volatility is actually going to rise more than you would have thought from just a simple volatility model. So this suggests the possibility of taking a view, a long-term view, and incorporating that in your risk measures. It's a kind of a stressed VAR, if you like, if you have risk people that are doing that. So what I've done here is just suggested some ways of thinking about this problem of how can we incorporate the risk that the risk will change. Because I think it's a very important feature that we want to make sure that our risk measures, which are short run, don't make our decisions ignore the long run. So suppose we actually were happy with a term structure of risk. How would we use that to change our investment portfolio? Well, one response, I think, has been to shorten your asset holding period. That you think you're buying these assets to hold for the long run, but you'll actually consider selling them sooner if it appears that the risk is going to go up. But of course, as soon as you say that you're going to sell them when the risk starts to go up, we have a market timing solution, and we have panic selling, and we, I think, see exactly what we observed, that everybody decided they wanted to sell at exactly the same time, and prices fell through the floor. And really, I think that's kind of October last year is an example of that. So what's an alternative to this market timing solution to changing risk? The theoretically attractive solution to this was proposed by Merton a long time ago, and it's called hedging. So there are hedge portfolios that you might consider buying, which would insure you against changes in risk. And these are changes in the investment opportunity set, was the way he described it. So what kind of a position could you take which would pay off when volatility goes up? Pay off when correlations go up? Pay off when the economy deteriorates? Well, one popular position now is actually to treat volatility as an asset class, and you could buy some volatility. Certainly, if you had a variance swap in your portfolio, you would see that higher volatility paid off on that variance swap at the same time that the rest of your portfolio was going down. But other things are gold, and we see gold is, of course, a very popular asset these days. Government bonds, high-grade corporates, and U.S. Treasuries. And actually, I could put in the U.S. dollar, maybe. These are all assets that actually did well in a crisis and could be put in your portfolio. Now, most of you also know that these assets, on average, underperform. You're putting assets which are high-priced and underperforming in your portfolio. But the reason you do it is because they underperform on average, but they outperform in a bad state of nature. And I think that if all of us who had invested in these used short-term risk measures for long-term assets had been required to, by your board or your risk manager, to take on some of these hedges, you probably wouldn't have taken such big positions. And it would have smoothed your capital flow in an important way through this crisis. So that suggests the simplest solution, which is to take less of this kind of illiquid long-term asset. And if you know that the long-term risks are high, it's not as good an asset for you. You might imagine you would choose to invest less in an asset that had high long-term risk than one which had low long-term risk. And consequently, the risk premium is going to be high on this asset, and its price is going to be low. And so your investment is going to recognize that if this long-term risk is solved somehow, then your asset is going to go up in value. So there is a change in price today due to the best estimate of what the long-term risk is going to be. And we're going to apply that in a second. So this is my discussion about risk measurement. And this is not necessarily a regulatory discussion. It's more of a discussion about what should sensible, forward-looking investors actually do to improve their risk measurement. And I think the answer is pay attention to long-term risks. And I would like to say a few words about the second major cause of this crisis, which is what can we do about the incentives? How do we correct the incentives for taking risk? People who are taking risk, but it's somebody else's risk. Or maybe it's the taxpayer's risk. So here's a picture. So this is a monkey, or a chimpanzee. He's in the top of a very tall tree. He's catching insects for his food. And he's taking a lot of risk. There's a risk that he's going to fall. There's a risk that the branch will break. Should we worry about him? Probably he's not going to fall more than once out of that tree. He is going to learn how strong the branch is. He's what? Yeah, he's probably going to learn how strong the branch is. And if he leans out further, he'll get more food, but he'll take more risk. But I don't think we have to feel that this is a social problem. This is an example of individual risk. He is taking a risk, and he's getting a reward for it. And this is the way financial markets work, or supposed to work. There is also a question of systemic risk when we say there are risks to the system. So let me show you a picture of systemic risk. Well, it looks like the same picture, doesn't it? But I have a new piece of information. This is the last male chimpanzee. So if he falls and kills himself, it's the end of the race. So we have a different feeling about his risk-taking than we did on the previous slide. No longer are we willing to let him take as much risk as possible. What solutions might we propose? One thing we might do would be to hire some government officials to stand under the tree with a tarp to catch him. There's a question of who would pay these government officials, and there's a question of whether that would reduce his risk-taking or increase it. It probably would increase his risk-taking. Another solution is to put a rope around him so that he can't reach out so far. But if you put too tight a rope, then he won't be able to feed himself. So this is the dilemma of the regulator. How do you regulate the amount of risk that this chimpanzee should take without spending a lot of taxpayer money and encourage him to take even more risk, and without stifling him so that he can't take any risk? And so these two pictures have very different implications. When it's a systemic risk, we have a different view as to how much risk should be taken. And so I think as we watch this regulatory discussion happen, we should remember that the goal is to reduce systemic risk taking, not all risk. And much of the regulation that's being proposed is actually, and regulation that we have had in the past, has been designed to restrict all risk, not just systemic risk. So how do we restrict systemic risk? Well, one thing is to have taxes or capital controls which are focused on the most risky companies. In fact, there is a lot of effort toward identifying which are the systemically most risky institutions, not necessarily all financial institutions, and how would you have especially strong scrutiny of them, and how would you reduce their risk-taking, because that is the systemic risk-taking. Secondly, there is a lot of interest in countercyclical regulations. That is, regulations which become more restrictive when the economy and when the financial sector is doing well, and less restrictive when it's doing badly, so that the risk is smoothed out over time. Thirdly, it's extremely important to coordinate this globally. That the U.S. and the EU and the Central Bank of China all need to have cooperation and coordination in their risk policies, and potentially some of this coordination should be enforceable. Otherwise, there will be countries which have low regulation, and the risk-taking will move there. We've seen examples of this through Iceland and Ireland and some of Eastern European countries, and we need to make sure that our appetite for risk levels the playing field across countries rather than giving some a risk haven compared to others. There is strong efforts to establish legal resolution authority to allow large corporations to have bankruptcy without undue impact to the financial system. There is a strong movement to move over-the-counter derivatives trading to a central counterparty insofar as possible, and to improve transparency in the derivatives market otherwise. And there is a big concern with rating agencies who seem to have underestimated the risk, and I think in exactly the same way by assuming that the risk itself was unchanged. So I would like to see actually rating agencies eliminated from risk measurement, use instead CDS prices or other kinds of market-based measures of risk. And so that this is kind of a quick list of things that are being discussed in great detail in the U.S. and abroad. It's now time to do this. The global economy is looking like it's coming out of this crisis period, even though we're not sure, but it looks like it's coming out, and we can turn our attention from saving the economy to improving it. It's particularly important that we recognize that we have limited ability to foresee the next crisis, so what we need are robust institutions and appropriate incentives. We can't expect our regulators to be smarter and cleverer than our financial institutions, so we have to set these systems up so that they are robust, that they can in a generic way foresee risks rather than that they understand the difficulties with complex products or something like that. So what can we expect? Maybe this is the best we can expect, but maybe this is what we can expect. Dancing with Barack. So where are we going? That's the title of this conference, in a sense. What do we see when we look at the economic data at this point in time? Mostly we're seeing positive growth in the third quarter for most countries around the world. Some are not, but mostly I think we're going to see positive growth in the third quarter. Not sure about the fourth quarter. There's some feeling that it might be weaker than the third quarter. Consumer sector is weak. It's weak in the U.S. for two reasons, and I think these same two reasons are probably true globally. It's weak because corporations have improved their balance sheet by laying off workers. So the stock market in the U.S. has gone up fairly substantially, and corporate profits are looking not too bad, but some of that is because they've laid off workers. And these workers, of course, are not big spenders because they're unemployed. Secondly, the consumer sector is weak because they've had a big loss in value. They've lost wealth in their pension funds, and they've lost wealth in their housing market. So the consumer sector has cut its spending very substantially in the U.S. and is actually now in a fairly strong saving mode. But maybe the world is going to provide demand for U.S. exporters, but the chances are that the same situation is playing itself out in other countries around the world, and so it's hard to expect external demand to fill this gap. And so the forecast most people are making is for slow growth in 2010, perhaps picking up in 2011 as the situation for consumers around the world improves. I think with a slow economy and a slow growth economy, the fears of inflation are low, at least in the short run, and our concern with that may be a little exaggerated. What about the dollar? Where's the dollar going? Most people ask me that. It's depreciated over the last 6 months, and why is it depreciated? Well, one answer is that the low interest rates in the U.S. are now the source of the carry trade. That is, people borrow in the U.S. and they invest in high interest currencies like now the Australian dollar, but Brazil, China is worried about this, and that this hot money is flowing from the U.S. to other countries around the world and producing the conditions for asset bubbles that they are very worried about. And that will lower the dollar and strengthen the alternative currencies as well as the assets that are invested in. Oil is a good example of this. Gold, probably another example of this. The second explanation for the declining dollar is debt refinancing fears. We have obviously run a very big deficit compared to what we have traditionally done. It's only exceeded by the World War II deficit in the U.S. And there's a concern whether the U.S. will be able to continue to sell its debt around the world, and if not, then what's going to happen to the dollar? Is the dollar going to fall at that point or not? A third explanation for the decline in the dollar is that this is a result of the global economy coming out of the recession, and that the volatility of the financial markets has gone down. Consequently, the dollar is no longer so desirable as a safe haven. In fact, the euro hit $1.50 yesterday, I guess, which was its highest point in 15 months. But you say to yourself, $1.50 for the euro, wait a minute, it was higher than that. It went up to $1.65 or something like that, the euro. But that was before the Lehman bankruptcy. In other words, the dollar is now back to more or less where it was at the beginning of September in 2008. And so if during the high volatility period of the crisis last fall, a lot of assets moved into dollar-denominated assets because of the flight to quality, then maybe we're just seeing that unwound. So I think there's a possibility that this decline in the dollar is really not due to the big public deficit. It's really due to actually the falling volatility of assets all over the world, and the belief by many investors that this crisis is in the past. But I do also think that the carry trade is an important part of the weak dollar, and I think that's going to be a concern globally for the U.S. and may well lead to a rise in short-term interest rates before the Fed says it will. So what's the global outlook? Slow growth, potential asset bubbles in countries that are receiving capital or with fixed currency regimes. I think this is likely to be a problem in China and Hong Kong, which are both have pegged themselves to the dollar. I expect a gradual, coherent increase in interest rates in 2010. ECB is already talking about it, but I think U.S. is not. But other countries like Australia are raising their interest rates, and I think that the U.S. will be pulled along to do that. There will be a gradual exit of government from capital market guarantees. We're still guaranteeing lots of stuff. I expect there will be an effort to try to reduce those, and eventually we're going to see a recovery of the mortgage markets, the housing markets, and asset-backed securities. But those probably will be the last to recover. But I think that the liquidity of those markets will come back even before the markets have strengthened, because banks will have written down these assets sufficiently that the market will reappear. Well, before I conclude, I'd like to just say a couple words about long-run risks. I've talked about the risk will change, but there are some very specific long-run risks that we might be concerned about, and these should influence our investment decisions. And I'm going to discuss three of them briefly. First of all is future financial instability itself. The reason we want to regulate this economy is because we are concerned that future instability is implicit in our current financial structure, and we would like to set up the regulatory and oversight environment to reduce the risk of future financial market instability. It's on the G20 agenda, and it's being hedged by investors who are going into gold and other assets because they're worried about this. If we reduce financial market instability by good regulation, we should see a reduction in long-run risk, which corresponds to an improvement in the markets today. So as soon as if you pass good regulations, that should increase the value of the stock market today. If you pass bad regulations, you may hurt the financial sector so much that the stock price would go down, but a good regulation should actually increase the value of the stock market because the long-run risk would be reduced. Another long-run risk is the risk of war and terrorism. And there are lots of reasons to think that in a financial crisis, these risks are getting higher. We also can see other reasons to worry about these, religious fundamentalism, social unrest, competition for resources. These risks also are presumably priced in the financial markets and should increase the cost of doing business. Stock prices are artificially low because of these risks, then it raises the cost of doing business and costs jobs. What should we do about it? Well, it's easy to say, let's promote peace and stability, but in fact, movements in this direction will potentially have positive benefits in reducing tensions, and as tensions are reduced, we might expect to see more capital flow back into asset markets. The final one I just want to mention, because when we think about long-run risks, global overheating is, in some ways, the biggest of them all. It's also farthest in the future, but, if it really means end of life as we know it, that's a big risk. And there's a question of whether financial markets are pricing that risk in right now or not. But I think potentially that risk is already being priced by financial markets. And so let's take a look at it. There's a lot of evidence for it, but not much evidence for the costs. And I think I better just jump through these, so I'll be quick. And I think the idea is simply stated, if this is a serious threat, what that means is that the global economy will be able to produce less goods and services in the future than they would have if the climate had not deteriorated. Whether it's hurricanes or rising water levels or whatever it is, it's just a reduction of what we can do. And whether the government pays for it or private sector pays for it, doesn't matter. It's going to be an implosion in our standard of living. And if that's true, asset prices might reflect on that. Well, you might say that's a long shot. I don't think that's really true. But if you did think it was true, what would you as a smart investor do? You would invest in companies that are likely to do well in a global crisis, when the global heating happens. That is, you might invest in solar energy firms or wind energy firms or alternative energy firms or other kinds of industries that are likely to outperform in planetary overheating. Some of you have probably looked at these stocks. They show very low profits, and yet they're expensive. These look like overpriced assets. Why are they overpriced? Well, because people are thinking of them as hedges. And it's the same as volatility, it's the same as gold, and it's the same, suggests the same argument applies to global overheating, that if you buy a hedge, you should expect this hedge to underperform in the medium term, but outperform in the crisis that we're worried about, which would be that the climate does deteriorate. So I think actually there is evidence that these stocks are being priced in the market, and so it suggests that anything we can do to reduce the risk of global overheating will show benefits in the stock market now. And this includes a successful Copenhagen meeting in 2 weeks, something like that. It would mean good negotiations with China and many other countries about the emissions policies. And in the U.S., the question is, what can the U.S. do? Well, my feeling is the U.S. already had a great opportunity to institutionalize the high price of energy, and they refused to do it. We saw when the gasoline was $4 a gallon, we saw many positive effects on consumer behavior in terms of driving less, using more fuel-efficient cars, and so forth. But because we would not take the important step of imposing a tax on gasoline, I think we may have missed that opportunity. Instead, what the U.S. is pushing for, which is the choice that Kyoto legitimized and will probably be part of the Copenhagen Agreement, is a cap-and-trade agreement where carbon emission credits are bought and sold, but these typically cover only a subset of all emissions, and they so far have been relatively ineffective because the certificates are given away in sufficient volume that there is no restriction on carbon emissions. So it's likely to be expensive and ineffective. So that's my concern. I don't see why in an era of great concern over the deficit, we don't just impose an emissions tax, which would be socially beneficial anyway, and cut the deficit and improve the long-term benefits of the planet. But in any case, it doesn't seem like that's likely to happen. So in conclusion, let me just offer 3 points. Make sure you take only the risks you intend to take, including long-term risks. So think about the long-term risks as you craft your portfolio. Regulators should reduce incentives to take systemic risks, not all risks, but systemic risks. And policymakers should know that if they can reduce long-term risks, there will be benefits today. So with that, let me close and invite you to my favorite cafe, the Arch Cafe. Thank you.